time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Yeah, we got another question from Garrett. He asked, Plurilock seems like it has a good product, but annoyingly, it keeps issuing more stock, diluting its value. We looked at this company, like Ryan said last year. We had very similar conclusion to the comments that Garrett had. But let's really look through what's changed over the last 7 months. And if you don't know, Plurilock Security, symbol PLUR on the TSX Venture. Plurilock Security Inc. is an identity-centric cybersecurity company that reduces or eliminates the need for passwords by measuring the pace, rhythm, and cadence of users' keystrokes to confirm their identities. They operate in a highly regulated industry, including healthcare, critical infrastructure, government and defense, and as well financial services. The stock is currently trading at 14 cents and a half at a market cap of 10 million and is up 3.5% year to date, effectively flat, depending on the exact trading price of the day. So a quick rundown of Q1 2023, their last quarter that they've reported. Revenue was up to 15.8 million from 7 million, a massive increase of 127%, but that's just largely due to they had 2 acquisitions within the year, as well as they do have a lot of fluctuation quarter over quarter because they're largely contract based. So if you look quarter over quarter, you'll see really big variations, and that should be expected going forward if you are looking at this company. 79% of the revenue did come from hardware and system sales, with 70% from software, license, and maintenance sales, while the remaining 4% from professional services. That's a big decrease from their hardware and system sales, which are more one-off in nature, which is a bit good to see. As well, you can see that reflecting their gross margin, which has been improving. Q1 coming in at 13.6%, which is quite a bit higher than previous years. Last year, it had a 6.6%. The increase is due, like I said, to the revenue mix, as more revenue came from that software, license, maintenance, sales, and professional service segments, which, of course, produces higher margin than hardware. However, profitability is still just poor. Plurilock had operating loss of 1.2 million, which is an improvement from a loss of 2.2 million, a net loss of 1.4 million, an improvement from 2.4 million, and on a non-GAAP basis, adjusted EBITDA was a loss of 1 million compared to 1.9. So improving, but still a loss across the board, regardless of what metric you're looking at. Plurilock does have a cash position of 1.4 million, that's including the restricted cash, but a net debt position of 1.9 million at this time, and they've actually paid off quite a bit of that over the last quarter. But like Garrett was commenting on, dilution is still occurring just regularly. At the end of Q1 2022, so about a year and a half ago, the company had 70.3 million basic shares outstanding. Now at the end of Q1 2023, they have 87.3 million outstanding. So at the end of the quarter, so that'll be a year over year at that point, is a 24.3% increase. Some of the share dilution was related to acquisitions, but even taking that out, you're at 19% dilution year over year if they didn't acquire anything at all. So that's substantial, to say the least. Further, the company has 13.5 million of stock options outstanding and 13 more million in warrants outstanding at the end of the quarter. But that's not the end of the dilution. In June, the company placed another 5.3 million units, which is 1 share and 1 warrant in one transaction, and then they did a concurrent transaction with another private placement of another 4.9 million units. Both those transactions sold the shares at 14.5 cents for the current market price, but they also had the warrants, which had a strike price of 20 cents. So even if you were to see the stock price rise, you would see further dilution once it passed that 20 cent marks, and we're just seeing constant dilution, and that's how they're funding. So really, that's why they're diluting their shares, is they need cash over and over again. The last quarter did have positive operating cash flow, but this was really just due to working capital changes, specifically an increase of accounts payable, which will need to be paid at some point in the future before the working capital changes, which we can see here. Plurilock had a cash deficit of 1.2 million during the quarter. So in reality, when you're ignoring the exact timing of payments and working capital shifts, the company has been consistently cash flow negative. So they need to raise money through either debt or equity. And as interest rates have rose and rose and rose, every company pretty much in this position is starting to shift to the equity financing. So they do have a outstanding line of credit, which they did pay down during the last quarter. And then they've actually, I think, shifted that out into equity financing as well, and therefore some of the dilution. As well, it would not surprise me the reason for the recent financing in June is they're paying down that accounts payable, which ran up over the last quarter, to make the cash flow seemingly be positive. But of course, it's not really. It's just really an accounting cash flow positive situation. So our take, the company is just far from any sort of recommendation this time. Yes, the revenue growth is good, but it does not make a company investable just off revenue growth. We've said this time and time again. You need the profitability, you need positive cash flows to become investable. They need to start producing cash flow from operations so they can stop this death spiral, I should really say, of dilution. If both share replacements close in the quarter, you'll see double-digit percentage share count increase just during Q2. That's just massive. If you're losing 10% of your effective share value quarter over quarter, that adds up very, very quick. You end up doing a rollback and you have 10 shares instead of 100 shares by the end of the year once they've rolled it back. And you've lost 90% of your value, most likely at that point. They're just not investable at this point. They need to get the cash flows. They need to get back on track before, even if they do have a good, eventually financially investable product, at this time, the dilution just makes it so you can't. And I really want to drill that in, is you need to look at the financials. You need to see them start converting before you can really invest in the company, regardless of whether the product is innovative or not.
Yeah. And this is why, people often don't get the whole idea of why we look at profitability as a minimum criteria in a company. And that's because, at the very least, you should understand what the road to profitability is clearly, because if a company isn't generating profit from operations, and that means they need to raise money from debt,
have to fund it somehow,
equity,
right? Yeah.
just to finance their expenses, right? And like, you could have a profitable company that issues shares or takes on debt for growth projects, but when you have to issue shares just to essentially keep the lights on, that's an issue that's not sustainable. And we want to invest in sustainable businesses. So, in some cases, there is a pathway that's clear to see to profitability, but it is an issue that a lot of investors don't focus on the profitability at all. And, if you are putting your money in a highly speculative company that doesn't have profits, doesn't even have revenue in some cases, or minimal revenue, you have absolutely no idea what the share count is going to look like by the time, and what percentage of the company you're going to own by the time it actually, makes that transition into net earnings, if it ever does.
Yeah. I mean, and it's a shame in this case, like the trailing 12 months revenue, 73.4 million. If you go back to December 2022, it was like half a million. So they, tremendous growth in revenues, and largely, made by acquisition, but the price to sales on this business is 0.15. That just tells you, like, if they could get any margin, like they need to get a good margin, but you got any margin out of this business. But that's why you trade at a 0.15 times sales. Like, it's just the business continues to dilute to keep the lights on going forward and keep funding any type of growth. And you don't see near term, you don't see a path towards significant profitability. And the path that we would chart at this point would be, at some point there'll be a rollback or a consolidation of shares, and that's because you're raising money at 14 cents or in that range, and it just, at some point you got to issue so many shares just to create any cash into the business from those shares. So at some point, that's what I would see for the business. I'm not close to it or anything like that, but that's what I would see happening. And then you do a rollback, and then, over that period, can you trust that management will continue to be good stewards, mind the store in terms of a capital structure? And, at present, the revenues are growing, but Aaron said, if you don't have a discipline for profitability, there is really no investment case in the business until you get that.
And the market sees that, because look at the share price performance over the last 2 years, right? In spite of that impressive revenue growth, the market is concerned that
that's why you're at 0.15 times sales. Like, that is a massively low multiple to sales, but the market is not buying that those sales are going to lead to any cash flow, which you need to drive the share price higher. And the only way you'd trade at such a low multiple to sales is if you have a low margin or no margin business. And right now it's a no margin business, to be honest. So, okay, we'll move on. I mean, again, there's far worse companies out there. Like, they've at least garnered some sales, but you need that profitability, and we want to invest in profitable businesses. And that's why you see the share price slump because there is no profitability. And we keep hammering that, but we will. Brennan, you got something on Carnival Corporation. We had a discussion this morning on cruises. Brennan apparently just absolutely hates them, thinks that anybody who takes a cruise is a degenerate and shouldn't be. I'm just kidding, but you've never been on a cruise though, so
I've never been on a cruise.
Brennan only
so
took that
I can't
position
say.
when he realized that you've taken a couple cruises.
That's true. It's true.
You're finding
Precisely.
another. So
Anything that I
Precisely.
do then is
And a
by
long-time
default
ex-girlfriend
for
used to
degenerates.
love cruises, so maybe it's tainted in my view.
It could be the hate
that's
for the
why they broke up.
ex-girlfriend.
Brennan wouldn't take her on a cruise.
Yeah.
Probably it. It's probably it.
Refused out of principle.
So
She's
yes,
like, I love you. Just take me on a cruise. Never.
I'm not going on a boat. Anyways, so Carnival Cruise, or Carnival Corporation, CCL on the New York Stock Exchange. We got a question from Jeff, and he says, Carnival Cruise reports earnings next week. The stock is still depressed since the pandemic drop. Do you think there is an opportunity? So yes, the stock is down about 70% since January of 2020, where it essentially halted operations and cut its dividend due to the pandemic, of course. And today, which is June 26th, is the time that we're recording this, the stock is down about 7% right now, following its recent Q2 2023 earnings results. But earlier this morning, it was down 11%. But so it has recovered slightly. And right now it's trading at a price of about $14.65 and has about a $20 billion market cap. So Carnival Corporation operates a fleet of more than 90 ships, which visit approximately 700 ports under AIDA Cruises, Carnival Cruise Line, Costa Cruises, Cunard, Holland America Line, Princess Cruises, P&O Cruises in Australia and the UK, as well as its seaborne brand names. So looking at the financials for Q2 2023, which drove the stock lower today, but keep in mind the comparables that we're going off of from 2022 remain depressed, so this growth is kind of one-off. But revenue came in at about 4.9 billion, which was an increase of over 100%, but was an all-time second quarter record for the company. So even though they are seeing that huge jump because of depressed comparables, they still did have a second quarter record, which was good. Adjusted EBITDA was 681 million, which was a substantial increase from a loss of about 928 million in the same period last year. Adjusted EPS was a loss of 31 cents compared to a loss of $1.64 last year. And while the company is still losing money, customer bookings continue to show positive momentum, reaching an all-time high of 7.2 billion and surpasses the previous record of about 6 billion reached in 2019. And you can see the company really, they're always comparing back to 2019, of course, which was when normalized times were. So looking at the balance sheet, they have about 30.6 billion in net debt, with about 80% of that debt being fixed rate and the rest at floating rates. And the company has a forward net debt to EBITDA multiple of about 7.3 times and a trailing 12-month times interest earned ratio of about 0.7 times, which is a bit of a concern because it remains under 1. And just to look at the company's 2023 guidance, which I also have up on the screen here, it does look promising as the company is projecting to get back into positive EBITDA for the year, but adjusted earnings remain negative. And if we use the adjusted EBITDA guidance, the stock continues to trade at about 12 times its high end of EBITDA guidance. And to put this into perspective, that midpoint there, about the 4.2 billion in adjusted EBITDA that they're anticipating in 2019, they actually ended up doing, I believe, about a 5.5 billion in EBITDA at that time. Now, the reason I believe the stock is actually down in the trading session today is because in the near term, CEO Josh Weinstein noted that high labor, fuel costs, and marketing costs are still facing the company. So that is a bit of a concern here. Now, the company also released a few targets. So they introduced its Sea Change program with a few strategic objectives going forward to 2026, which include more than a 20% reduction in carbon intensity compared to 2019. So they're trying to reduce their carbon footprint. 50% increase in adjusted EBITDA compared to their 2023 June guidance, which I had up on the screen previously, which represents the highest level in almost 2 decades if they can achieve it. Adjusted return on invested capital of about 12%, And these estimates are based on net capacity growth of less than 2.5% compounded annually from 2023. And by the end of 2026, the company is expecting to approach investment grade leverage metrics, as both Moody's and S&P had downgraded them to non-investment grade following the pandemic. So to conclude, overall, I think that Carnival Corporation is in the right direction as the financials appear to be on the path to returning to pre-pandemic levels, with bookings increasing to record levels and the company beating its Q2 guidance. But the company still has a lot of work to do, as its profitability remains depressed and has a very levered balance sheet, which is a concern. And given the elevated debt levels and continued cost pressures, I do not believe that the stock would be worth an investment at this time, at least not until they can pay down a significant portion of their debt and show that they can continue to achieve their profitability targets going forward. And just on my note, I would never go on a cruise personally. So I don't think that I would invest in a cruise company unless they had, 20% growth at 10 times earnings. Then I couldn't turn it down. But at this point in time, I would not invest in Carnival. Okay.
Good assessment.
That's a massive bias. I don't know what we can say there.
It is a bias. I will say it is a bias, and it's an unreasonable bias.
Brendan,
I don't
it's
even
not
know
about
why.
the 7 times.
You got to be open-minded.
Open-minded.
Yeah, it's
Lack
not
of
about the debt. It's all about just.
No.
wanna
What's
go on
interesting to
cruise.
me is that bookings are at a record, even a pre-pandemic record, yet they're still not making money.
Yeah.
Right. And they can't really add more debt. They don't want to issue shares or shouldn't add more debt. Rather, they probably don't want to issue shares at the current price.
Yeah.
So it's not plus we're in a situation where, we are in uncertain economic times, potentially entering into recessionary times. How does that impact their business? If they can't get profitability with record bookings now, what's it going to look like? When
Despite like a bit of a denial from the average consumer, like inflation has squeezed disposable income, and cruises are part of disposable income. They should be facing a tougher time over the next 18 months than they likely faced over the past year. So in terms of, everybody had just got back to traveling, was clamoring to go somewhere.
Generally,
there are people that still don't want to cruise right now, so maybe
are
they
cruises
get some
like
of those
more
people back.
cost-effective ways to travel? Technically, again, you're talking
Depending on, there's cruise A,
yeah, I guess
cruise
it
B are
depends.
completely different.
Because you guys have been on some cruises before, and even
Yeah.
I will say Ryan even kind of convinced me that I think a Mediterranean cruise actually would be cool because I love history.
Well, he's backtracking.
Be kind of.
I don't know if I would
backtracking.
say that their costs. They're
No.
more cost effective.
Okay.
You can spend a lot of money on a cruise.
Yeah, that's what I
You
mean.
can
Cruise
travel
A to
Europe
cruise B is
for
completely
relatively
different.
cheap if you want to, stay in hostels, or you can travel Europe, for at any price.
And you
right?
can be in a
So
balcony room versus inside room versus
Yeah.
suite versus like there is
Fair
you
enough.
can spend unlimited amount on a cruise. You can spend unlimited amount on a hotel in a certain country.
One thing
too.
I
It
will
just
say is that
depends on what
if
you
you know what to do, you can get good deals on cruises. So in some cases, maybe it is more cost.
Yeah,
effective,
we've
but-
always gotten good deals. It's a great way if you've like never been to Europe or through the Mediterranean. Like we saw 11 countries in like a few weeks, and like then you can maybe pick out one that you like, oh, I really love this country. Then we can go back and spend a couple weeks there, a week there, whatever you want to do. If you went and said, I'm going to commit, I'm going to spend 2 weeks in country X, and you got there and you said, this sucks.
Yeah,
that would suck, right? So I mean, it is a way to kind of sample. It's like going to a buffet and then you pick out, I like, Mexican food or something, and then you're going to go to a Mexican restaurant, right, Brennan?
I think
so try it.
The other problem is I'm such a nervous Nelly that I think I'd be scared to leave the boat because I don't know if I'd make it back to the boat in time.
Oh, this is true.
This is so true.
Like we'll get to any city, like an analyst city, and Brenny's so when do we have to go to the airport? It's like, it's 5 days from now.
One of the good things if you're in Europe, if you do miss the boat, is you can always just go to the next port. Like you can get there pretty quickly. I doubt it's that far
Brennan
away.
would just throw himself in the water before that happened.
I'm
done.
If you're doing like I don't know, a cruise around Asia, and like this is the last.
Yeah, you're done.
Last port before you head back to North America.
Well, I will say, this is a little shot at myself. My first time in Vegas, I was scared to leave the hotel room because I thought I was going to get lost in the casinos.
Yeah.
I love making fun of myself.
Wow.
It's good.
Yeah.
It's a true story,
If
though.
you can't do it, right?
Yep.
All right. That's good. All right. Well, that's going to end off
All
our
right.
show this week.